Hi, everyone, and welcome to Behind the Numbers. My name is Dave Bookbinder, and welcome to the show that goes beyond the data to explore the people, stories, the insights that drive business success. And today we're going to be focusing on the people part of the equation. And I'm thrilled to have somebody joining us today who I've been on panels with. We've shared the stage together, and for about a minute, we actually worked together in a former life. That's Dr. Solange Charas, who is professor of professional practice at Columbia University, and she's also the founder of HC Moneyball. Solange, welcome to Behind the Numbers.
Thank you, Dave. I'm so glad to be with you again, share the stage. And yeah, that was a memorable couple of minutes where we worked for the same company.
Right. Hey, is that you? All right. Good talking to you. See ya.
Yeah.
So tell the audience a little bit about who you are, and then we'll jump into the conversation.
Sure. So as you described, I'm a professor of practice at Columbia University. The professor of practice role is really special because it combines scholarly work with practitioner work. So my accountability in my role is to actually be in the market as a practitioner to bring that experience back into the classroom for our students. And all of our students are master's students in human capital management. So my mission is to prepare the next generation of human capital practitioners with what I mostly focus on, which is quantitative areas of human capital. So the measurement part of it, finance, data analytics, anything that is quantitative in nature, so that we're changing the footprint of the HR practitioner from someone that's very qualitative to someone that has the skills to bring some quantitative rigor to decision making.
And that's so important because I've spoken to so many HR leaders over the years, and they've all said the same thing. To get the seat at the big kids table, so to speak, they can't be talking woo-woo to CFOs and CEOs. They need the data, they need the numbers, they need the language of finance.
That's exactly what we say, is that you need to speak the language of finance. You need to speak the language of business. And business employs a language of finance, a financial language.
Yeah.
And so we want our graduates to be very facile in that language. And one of the things that we're leaning into now is AI and agentic AI and the impact of AI, not only on human capital, but on organizations. How do we manage? How do we help manage that transformation? How do we help manage the skills that we need and the skills that we need to develop for organizations to be competitive in a world that we can't even imagine at this point?
Yeah. Listen, you've already got the chops and the qualifications to be here to have this conversation with me, but I need to touch on two more things or I'd be remiss as a host here. I want to give you a chance to talk a little bit about HC Moneyball, what that is, and you have a book that maybe you should mention as well.
Thank you. So HC Moneyball, you can tell from the name, is an organization that is using data to gain insights about business outcomes. Specifically around human capital performance. So what we do is we work with organizations and we work with consultant firms, service providers to help build a business case related to investments in human capital from the perspective of human capital being an investment in an intangible asset versus human capital being an expense. So we're working in this new framework around how to think of people as your product and as your driver of economic value creation, and how to optimize the management of programs and people to achieve those outcomes. So that's what HC Moneyball does. And the book was co-authored. I co-authored it with a brilliant woman named Stella Lepouchore. She is truly an HR futurist. She spends her time thinking about the future of work and the future of HR. And I, sort of follow along with my data analytics approach and my human capital materiality approach. But she's really brilliant. And the book is unique in that it is a combination of human capital future perspective plus the rigor of data and financial analytics to support that. So there are a lot of books about data analytics, and there's a lot of books about the future of HR. But this book is different because we combine the two. We help you think about new ways of, I guess, contextualizing human capital as a driver of value. And we support that with ways that you can measure and prove out that value to the organization.
Yeah, and that's so important here. And I want to just emphasize for folks who are tuning in and they're hearing the word human capital, because I know that when I dropped my first book, The New ROI, Return on Individuals, and I talked about how I'm trying to change the conversation about human capital as treated from an accounting and valuation perspective, there were some people who blasted me and told me human capital is a derogatory term. People aren't assets. I'm trying to explain to them that, yes, they don't appear on a balance sheet, but we don't want them to be thought of as expenses. They are your most valuable asset. And just to set the stage here, human capital is one of those terms of finance or business that is generally accepted in terms of how you're speaking about your workforce, your human capital. So please don't anybody out there think we're talking about this in any kind of a disparaging way. We are on your side, I promise you.
Yep.
So.
Yep, absolutely. If you think about human capital as the input, the labor input into the business model, it becomes clear that it's not a derogatory approach. It is really just thinking about what do we need from a human perspective to meet our business model and be successful. And for most organizations, they spend more than 50% of their operating expense on people. So it is the most leverageable part of the business cycle, of the operating part of the business. And we need to think about it that way. And here's a way to help you also contextualize it. If people are the product, cutting heads is like draining your car of gasoline and expecting the car to get you to your destination. So this is the fallacy is, HR has the biggest budget. We have profit, we have a profit crunch, or we have a profit challenge. Let's cut our biggest expense. Well, cutting the source of economic value creation is sort of a dumb thing to do. If you take it at a wholesale level, you might want to think about how to optimize productivity in the organization and rethink human capital as a strategy, but you don't just wholesale cut your source of economic value creation.
Yeah, really well said. And unfortunately, that's exactly what happens because too many companies are managed on short-term goals and objectives. For instance, the public companies are managing towards expectations for quarterly earnings. And if they're not going to hit them, what do? Right? Hey, leaders want to get their bonuses. We need to meet our stock price, got to keep everybody happy. So like you said, we're going to cut that largest expense. And there is such a fallout from that we haven't talked about yet. And I didn't know that I was planning on doing it, but here we are. But when you start to whack your workforce in that way, you lose the institutional knowledge that walks out the door with those people. And sometimes it's really hard to understand what that means until they're gone. It's all the nuanced stuff that people have accumulated over the years of having learned how to work with Joe and what Ed's expression means. And when you go see Jane, you don't want to talk to Jane until she's had her coffee and all those sorts of things.
Or even the client-facing talent that know their clients, that know, that the head of marketing from this company has 3 kids and what their kids' names are. Those kinds of relationships are really valuable to an organization, having that kind of knowledge. And it's fascinating to me that CFOs haven't figured this out already, that the cost of replacing a worker, we all know it. Gartner comes out with this information. Deloitte comes out with this information. All the accounting firms, they have basically a position that says replacing a worker is often 50 to 100 to 200 times their base salary.
Yeah.
So if you think about, I'm going to do short-term cuts and I'll just rehire those people 6 months from now, what are you doing to your cost structure? Instead of just letting people stay in their jobs, perhaps not as productive as they would be, it's not costing you multiples of salary to rehire them, to wait for them to get up a learning curve to be fully productive.
Yeah.
And here's something that I know that you and I have talked about, which is average salary compared to average productivity. And CFOs should be looking at that ratio every month. And they should, be monitoring it to make sure that, in fact, the organization is benefiting from every dollar that they spend on salary.
Yeah, I want to unpack that formula with you in just a second here, but I need to weigh in because I think this is important because it started the train rolling for me. You mentioned, and data supports it unequivocally, that when you're trying to replace an employee, it's multiples of their salary. But yet, in my world, in the valuation profession, when we value the assembled workforce in the context of an acquisition, we're using a cost to replace method, which basically presumes you're all fungible.
Yep.
And the cost to replace is a fraction of what we know it really should be. So that's why I'm trying to change the conversation here. And I'm thrilled to have you with me here sharing this knowledge.
Yeah. And here's an important thing that everyone always forgets about: the value of time, or the time value of money, right? So when you value a workforce and you say it's the time to replace, you make an assumption. You make a few assumptions. One, which is what you already talked about, that talent is available and qualified for the jobs that you're trying to fill. And two, that the minute you look for somebody to fill a job, you automatically find them. And what we know is the case is that today it takes anywhere between 45 and 90 days to fill a job. And that's not even in the tech sector. In the tech sector, it takes longer to fill jobs because there's not enough talent. If you think about the fact that employees are creating economic value, that every day an employee is in the job, they're actually either directly creating or supporting the creation of revenue. When you don't have somebody in that job, you are actually weakening your revenue creation possibility, opportunity, because you don't have somebody in that job creating value. So what CFOs neglect to think about is they think, oh, I have an open job, which means I get to save on salary, right? For every day that that job is open, I don't have to pay a worker that day's wage. But when you have workers that are producing 2.5, 3 times value, revenue than their wages, you're also losing the opportunity of creating that revenue. So CFOs have to start thinking differently about the strategy of cutting heads, because it's not just saving expense. You have to quantify the opportunity loss around revenue creation. And that's often unthought. You don't think about it. So
no, and oh, by the way, the other thing they don't really consider is the impact on the people that are left behind.
That's exactly right.
The survivor syndrome and the lack of loyalty that you are now creating because people have seen how you behave, and you want their loyalty, but they want yours as well. Let's jump into the number stuff. You started to allude to a formula. I don't want you to lose your train of thought on that aspect of it, but everybody's heard you can't manage what you can't measure. And let's talk about some of your favorite metrics that leaders should be thinking about in terms of how to measure the impact of the people in the organization.
Yeah. So the mother of all metrics, I think, is something called HCROI, Human Capital Return on Investment. It's been studied in the academic world for about 30 years. I did not make up this algorithm. It's been, as I said, studied and proven. And it's very easy to calculate, and it's very easy for a CFO to understand because it doesn't have anything HR outcome related in it. It doesn't have culture. It doesn't have engagement. It's really easy to calculate. It's revenue. The numerator is revenue minus operating expense. And depending on what industry you're in, maybe you want to do overall expense. But if you're a heavy on operations and less on finance and investment in your P&L, then you want to use operating expense. Adjusted for the total cost of workforce. The total cost of workforce is everything in your general ledger that you code to HR. So that's comp and benefits, which is going to be the lion's share, learning and development, contractors, performance management programs, HRIS, company picnics, the Christmas party, whatever you code to HR is going to be included in your total cost of workforce. So your numerator is an adjusted revenue number that takes out the cost of workforce. The denominator is your cost of workforce. So you can see that this is a real return indicator, right? So if your numerator is adjusted profit, adjusted for the cost of human capital, and you divide that by the cost of human capital, you're getting a real return number. Anything under 1 means that you are not getting an adjusted profit greater than your expense, than your investment in people. And anything over 1 is good, because the dollar that you invest in people is generating an adjusted profit that's greater than $1. So that's a real easy benchmark number. We always say, don't look at it year by, in a single year. You have to look at it as a trend. And the other thing that you should be doing is correlating that number to your profitability. When you spend more than 50% of your operating expense on people, they will correlate. They will go together, unless there's some extraordinary event that you're booking. But for the most part, as HCROI goes up, your profit will go up. Why? Because they're a tautology. Profit is revenue minus expense. HCROI is revenue minus an adjusted expense divided by what you're adjusting it for. So they go together. And that's a really easy way for a CFO to understand how human capital is either driving, contributing to profitability, or is detracting from profitability.
So I'd have to ask on behalf of every CFO out there who just heard you say that, if the ratio is below 1, what do they do to increase that efficacy?
Yes. So that's where the art of the science of human capital comes in. You now have to start unpacking what's going on in the organization. And I would say the first place to look is attrition, because attrition is the most costly thing for an organization. Yeah. So we have a couple of calculators on our website. So if you wouldn't mind, I'll just say it's
Please do.
www.hcmoneyball.com.
Yeah, go there now. No, when you're done listening. Sorry.
Yeah. And if you go there, you'll find a tab that says resources, and you click on that tab, and we have 2 calculators there, an HCROI calculator and an attrition cost calculator. For the HCROI calculator, you put in 4 pieces of data, and not only will it give you your current HCROI, but it will show you what a 5% improvement in HCROI will do to your profit. And again, if you're spending more than 50% of your operating expense on people, you will have a very leveraged and positive impact on profitability. The attrition cost calculator, you need a little bit more data, but it will tell you how much attrition is costing the organization as a percent of your payroll. So it's an easy way to say, our attrition rate is 20%, and that's costing us 40% of our payroll. If we can drop attrition by 2 or 3%, then the cost of attrition decreases precipitously. And then you can understand, well, raising salaries by 2 or 3% help us drop our attrition, and then drop the cost of attrition greater than your salary increase budget. So it's a way to actually do some sensitivity analysis to see what's what. The underlying assumption is raising salaries will lower attrition. You need to test that out in your organization to see if that holds. And you do that by looking at historic data. So when your HCROI is below 1, first place to look is at attrition. And then the second place to look, I would say, is at recruiting, because that's also very costly for the organization. And then maybe break it down if you've got divisions or different P&Ls to see which P&L. And remember, every time you have a P&L, you can calculate an HCROI. So you can calculate HCROIs for every division or every function if you can identify the revenue and the expense. And then start looking in your organization for the root cause. So maybe there's an area in your organization that is actually an outlier in terms of performance. Maybe it's IT, where you have a lot of attrition or a lot of, inefficient use of budget. But you have to sort of be a detective. That's, as I said, where the art comes in.
Yeah, and a lot of times when you start to look at the attrition hotspots, you can tune in on maybe some leadership issues, because it's still true today that people generally don't quit their job, they quit their manager. And if you see there's a high level of turnover around a certain manager, yeah, maybe you start there.
Yep, you're absolutely right. And I love that concept that people go and work for a company, but they leave their managers. And it puts a different level of accountability on management to retain their talent and manage it the right way. When I was at CHRO, we had I applied a lot of data analytics in managing the function. And we discovered that there was an inordinately high amount of female attrition in the IT department. And we followed the data, and we found a sexual predator in the IT group.
Wow.
And as you said, it hurt our brand, because anytime an employee leaves and is disgruntled with a social media machine, everyone knows about it. And then nobody wants to come and work for an organization where there's a certain behavioral trend that is damaging to people.
Yeah.
So,
for sure.
Very powerful. Social media is very powerful in managing employer brand.
100%. So you've shared some really good numbers for helping us to measure our people and the impact of our people in the organization. But in the US, the requirements around and the disclosures around human capital reporting are, we could do better.
Anemic.
Yeah, there you go. That was my way of saying anemic. Why don't you explain to our audience what's going on with U.S. reporting, and maybe compare and contrast that with international standards, which seem to be leading the way here?
Yep. So one of the things that I do in my spare time is I'm actually part of the International Standardizations Organization Technical Committee 260. I don't know why it's called that, but it is a group of people globally that focus on creating new and managing existing human capital standards for the ISO organization. In 2018, the technical committee came up with a standard called Human Capital Governance and Reporting. The number of that standard is 30414. So you can go and look it up. And at the 5-year mark, the ISO organization decided that it was time to update that standard. So in 2023, I joined the working group to update that standard. The standard is sort of like a Bible. It's got a lot of metrics and ideas, concepts for how to quantify the impact of human capital, not in the aggregate exclusively. The HCROI metric is embedded in that standard to measure overall human capital performance. But we delve deeply into each of the subfunctions. So recruiting, retention, performance management, learning and development. And in fact, the standard has something like 54 different metrics that we have distinguished For the most part, those different metrics are to be used internally to help human capital practitioners make data-informed decisions. There are only a handful of them, like 12, I guess 2 handfuls, 10 to 12, that we recommend be disclosed externally. The reason that we felt that that was important was because, remember, back in the mid 2020s, the SEC was talking about making human capital disclosures for all public companies be rules-based versus principles-based, which it is today. So in 2020, the SEC required that all public companies disclose on human capital performance that they deemed material to financial or legal performance. And we've seen a lot of disclosures over the years, but none of it really quantitative, most of it qualitative. And under Gary Gensler, there was an expectation that he would require rules-based instead of principles-based disclosures. And that simply meant that all companies would have to calculate certain ratios, certain metrics, and disclose those metrics, and that it be auditable, which meant that public companies would have to aggregate all of their human capital costs, their total cost of workforce, in a line item to be included in their income statements, with an accompanying note, so that we would have a lot of transparency. We would know how much companies are spending on human capital. We would know information about their workforce composition, full-time, part-time, gig workers. We would know something about their diversity. So that would be required reporting. We would know something about the stability of the workforce in terms of attrition and average tenure. And all of these pieces of information help us understand the health of the human capital of an organization. Unfortunately, it never came to pass, and the new head of the SEC, whose name I can't remember, unfortunately, under Trump's administration, is not going to require this kind of transparency about human capital performance. So all of our hopes were dashed on the ISO committee, because our standard would have been used to help public companies calculate all those values, because we want everyone to calculate using the same algorithm so that we can do apples to apples and not allow organizations to make up their own algorithms for reporting. So that was a big disappointment, and we can only keep our fingers crossed that the stakeholder community, including investors, will put pressure for those kinds of disclosures to happen in the future. But what's going on outside of the United States is pretty interesting and exciting. The country that is in the lead is Japan. So they have required human capital metrics disclosures. They're leveraging that in really interesting ways. So, for example, there is an insurance company that is providing discounts on premiums for their not just human capital oriented insurance policies, but for property and casualty insurance policies based on the health of the human capital of the organization. So the better their metrics, the higher the discount on premiums for insurance coverage. So I think that that's fascinating that they're linking human capital to risk, which makes sense, right, Dave?
Yeah.
So Japan is very far ahead of the rest of the world. The next to bring up the next car in the train is Europe. So we've had a lot of activity in the European sector in terms of required disclosures. The EFRAG issued ESRS standards. There are 10 of them. 6 of them are 5 of them are environmental, so it's ESG oriented. 4 of them are social from the S, and 1 is governance. And in the column under social, there are 2 standards, ESRS S1, S being social, and ESRS S2. 1 is the most important, ESRS S1, which is own workforce. It's called own workforce, OWN. So your own workforce. ESRS S2 is called supply chain, and there's a human capital part of ESRS S2. Originally, so it was voted in the European Union, it was passed, and then we hit some snags. The reporting was supposed to roll out large companies first, mid-sized companies second, small companies third. Originally, it was supposed to be 2015, 2016, 2017. Now it's got pushed out. We're still supposed to see some reporting from large organizations in 2016, but that's probably going to get pushed out as well. And there are some questions about which U.S. organizations have to report and report what. So if you trade on if you're a U.S. organization and you trade on any of the European stock markets, stock exchanges, you are required to comply. But the requirements aren't clear on whether or not you have to report on your entire organization or only on the employees that are in Europe. And so we're not sure yet what that's going to look like. Then TISD came out, which is another standard. So there's a lot of conversation around human capital reporting, and it's evolving. And I think it's all good. I think that we're talking about human capital in the right way as a material impact to sustainable financial performance. We're talking about human capital from a social perspective. It's all good.
Good. We are just about out of time here, but before we wrap, Solange, I want to give you an opportunity to talk to the folks who are not the CFOs listening. We've already given the CFOs the love and giving them some of the tools they can handle. Yep. What's your message for the people who maybe aren't in a position to make the policy decisions inside their organization, but want to raise issues and effectuate change and just do better for their companies?
Yeah. Human capital is a really interesting function in the organization because it has so many sub-functions to it that I don't think management really appreciates how complex and interconnected human capital is and the impact that it has on organizations. So even though we want to frame everything as a business case, so a rational decision maker can then prioritize, the rational decision maker being the CFO, then prioritizes how they allocate limited resources to each function. The best advice I can give an HR professional or a human capital professional is think about human capital as a business. Think about it as a way of creating a business case to prove out the return on investment of your allocated budget. So let me give you an example, a story. I recently helped a chief people officer of a very large healthcare system support her budget ask. So her overall budget was over $3 billion. And she came to me and said, I need another $161 million, about 3% more. And she said, I don't know how to ask for 3% more, especially in this environment where they're all looking to cut my budget. So we looked at the human capital function. We actually started with attrition. We looked at recruiting. We looked at retention. We looked at the revenue generating or the patient facing roles compared to the back office roles. And we created a business case. And the way she was going to use that $161 million more was around retention and filling jobs faster. And we were able to quantify the benefit to the organization of reduced attrition and filling jobs faster. And in fact, it was more than $161 million. So the benefit of the $161 million was greater than the investment. And we showed the ROI of that, and we showed the timing of that. So we want to look at ROI, we want to look at net present value of money, and we want to look at the internal rate of return of that investment. So how fast is the organization going to get their money back? And when we presented her $161 million ask as a business case that showed investment and return on investment, she actually got $100 million more than she asked for. So have you ever heard of an HR person going to a budget meeting and getting more than they asked for? No.
Most unusual.
Yeah. And why is because we changed the framework. And this is what she said. 6 years she's been in this role. And it's the first time they talked about HR as an investment, not as an expense. So my story, my message is, if you're an HR practitioner, you need to rethink and reframe the way that you think about HR, from how can I spend this money to what's the benefit that I will generate for the business by investing in selected initiatives. Measure that and prove it out so that you're not the only function that goes to a meeting without an ROI or an NPV or an IRR metric, because everyone else does, including sales, including marketing, including operations, including procurement. Everyone talks the same language except HR. And that's my message, is HR people need to think about HR as a business case, not as an expense.
That is a great message. Tell the audience how they can find you if they want to learn more about you, contact you, find your book.
You can find my company at www.hcmoneyball.com. You can find me on LinkedIn, and I appreciate connections. So please feel free to connect with me. I post 2 to 3 times a week. I post content, and I, maybe can help you figure out how to transform your human capital practice into a business practice. So find me on LinkedIn, Solange Charas. I'm the only one in LinkedIn with that name, so it won't be hard to find me. You can follow me on Forbes. So I'm a columnist. I publish twice a month. And if you go to Forbes.com and search for Solange Charas and follow me, you will get my articles, my columns pushed to you. And if you want the book, you can go anywhere that you buy your books from, and I'm going to push you to Amazon. But the book is called Humanizing Human Capital: Invest in Your People for Optimal Business Returns. And we do have a website, which is www.humanizinghumancapital.com. And you can sign up for our newsletter there. Gosh, I'm all over the place.
You really are. And you know what? The newsletter is money. So make sure you all out there sign up for that newsletter. Solange, Thank you so much for joining us today. Really great to have you here on Behind the Numbers.
Thank you, Dave. I love talking to you.
It's all my pleasure. And thank you out there for tuning in to Behind the Numbers. If you enjoyed the episode today, and I know you did, please take a moment to leave us a review on Spotify or Apple. That stuff really does move the needle, and it helps people find us. Until next time, I am Dave Bookbinder, reminding you, and this is very timely for this episode, the numbers tell the story, but the people bring it to life. Take care, everybody. We'll see you next time.